Hey man, you gotta watch out, man. You gotta watch out. Oh man, a huge warning for Bitcoin longs. Bears have finally awoken at this key level around the 21,000 mark. What does this mean? Should we be taking chips off the table? I'm going to share my position, what I'm doing in the market, where I think we could be heading from here, because a lot of people are going to get wrecked if they're not careful. As always, don't forget to smash the like, don't forget to subscribe. Check out the links in the description. If you want to trade in these moves, you can do so using BYBIT or BITGET. Those are the two platforms I personally use. They're offering some great bonuses. Definitely check them out. As you guys know, if you're new around here, I'm a big proponent of not using margin, not using leverage. Bitcoin was on a nice breakout, right? Everybody knows this was no surprise. We had a huge breakout of this large triangle pattern which we were forming. Focus here on the big yellow pattern. We broke out of this and had a nice big move to the upside. Now, on Sunday, we had a slightly red day, just down 0.37. And today, just slightly red. But it's finally given me the clue that the bears are waking up, and I've got a few important indicators which I need to share with you, which are making me rotate just a little bit of risk off to make sure I get some chips off the table and wait for a stronger position to re-enter. Now, it's important. This video is about short-term trading. If you're a long-term holder, the majority of my portfolio is in long-term holds. I always have to give that caveat because people just tend to get confused. The majority of my crypto net worth is in long-term holds. I don't touch it. I DCA into it and I let those position rides through bull markets and bear markets. In terms of trading, which is what we're talking about now, I'm looking for entries. I've got an entry point. I've got a stop loss. I've got to take profit, and I get in and out where possible. I will not win every single trade, but I'm going to stack the risk in my favor. Definitely check out my free TA course, ijaz.uk/TA. So this is the pattern we're working on, but I want to show you the other one because this was the original pattern which we reversed from. So you saw this triangle, we faked out to the upside, we broke down to the downside. That's old news, right? That's the FTX. Then we spent some time around here, we created this double bottom pattern, we finally got an immense breakout. And by the way, guys, that is like the ultimate breakout you're going to get from a reversal pattern. That is the best case scenario. Look at that. There was no sideways action, no red candles, it just went straight up there. Normally on a breakout, and I said this at the time, I would be perfectly fine with something like this, like that still gets your price target, right? That's what you expect from a normal breakout. This was a parabolic breakout with a huge move to the upside. Now we're starting to see some resistance, which is interesting. And look where we're seeing the resistance. It's at this blue line. What is the significance of this blue line? It's the peak of the 2017 bull market high in December. Right? So it's no coincidence that the bears were sitting somewhere. It's just that they didn't want to sit at the levels that we were just at. So they let the bear, well, they didn't let the bears, but the bears capitulated those, the bulls capitulated those bears on the upward side, and they're sitting here sniping. And that's what's got me a little bit worried. I'm going to show you why. Let me drop down to the hourly. What do you notice here? And again, if you're not spotting these kinds of things, ijaz.uk/TA, work through that. It's supposed to be like an encyclopedia for you. Keep it open. The chapters are really straightforward. You can just click into them as and when you need them. Yes, you can watch it all the way through once, but use it as an encyclopedia for you as well. So we were forming this triangle, the yellow triangle, right? And this is a bullish continuation pattern. You got the breakout to the upside, right? So you met most of your price target and you could have taken your profits there. And then since it's got rejected back down to the downside, which is interesting. Now what you can see is if you wanted to adjust, you're forming a bit of a bull channel like so, right? You are forming a bit of a bull channel, which I'm just drawing like so. Okay, so it's still a bullish continuation pattern, but things have changed. I'm just going to pop off these yellow lines for a second. Let me just remove those. And what do you notice? If you look at the orange lines, what do we see? We see bearish divergence. Okay, this is bearish divergence where you're getting higher highs on the price action. You're getting lower highs on the RSI, i.e. an uptrend in price action. But the RSI, which is an indication of overbought or oversold, is showing that this is overbought. It's heading to the downside. So this is a bearish pattern. When you see this, you should be thinking, I need to get some chips off the table. There's something going on here. So now that we've identified that, where could we get to? Where could the support be? Well, if we're looking at it from this point of view, which is simply the pattern which we broke out of, there isn't much support here, right? If you're just looking at this pure pattern, where would the support be? It'll be coming all the way back down to 17,800. Now, realistically, I don't expect that to happen. I don't think the bears are going to push this all the way back down and we give up everything we've just had. over the last 4 or 5 days. So let's look back at this format of the chart we were looking at. And when you look at this triangle pattern, you can see a few more obvious support lines. Now, the first support line is going to be your 20,000 level. Now, the 20,000 level is important because it's your psychological level, 20,000, right? That's a horizontal support. It's a psychological key level. Then, failing that, if the bears have good strength, I'm then looking at 18,800. Okay, and the way I'm going to decide that is by looking at the volume candles and looking at the way the candles print on our way towards 20 to see if I think the bears have enough strength to take us down to 18,800. If they do, I'm going to hold off any entries. If we then get to 18,800, which, by the way, look at this, is a very important support line from this channel dating all the way back to June, guys. Okay, this is a very important channel, an 8-month channel we've pretty much been in, 7-8-month channel we've been in here. So that's got to hold for me. If that doesn't hold, then we look at 17,600, which is the neckline of the reversal pattern I just showed you, right? That's the same as this green line here. So that's the worst case scenario I'm playing out. We've got a few important supports coming up before then, which I'm looking to focus on. And particularly the one I'm looking forward to is 20 and then this 18,700 bottom of the green channel. Now, what do you notice about the bottom of the green channel? Well, I spoke about this a day or so ago, just before the weekend, where I said, do not be surprised to see this. And in fact, it's healthy. If we see something like this, it's healthy. Even I'd argue, guys, seeing this is healthy. Now, why? Remember, when you have parabolic moves to the upside, the way I like to think about it from a medium to long-term perspective is you built no scaffolding. You've almost climbed up a building, but you built no scaffolding. Now, if you're like a gamer, you've not really gone through a checkpoint where that if you get revived, there's somewhere for you to go without starting the game back again. Right? So it's important always to retest levels once you've broken through them. Once you've broken through a level, come back and test it to prove almost that it is now support. Remember, you turn resistance into support. So this channel was resistance. We broke through it. Let's hold it as support, just like we did here. Right? Let's hold it as support. If we can, even better, hold 20 as support. If we can't hold 20, if we can't hold 18,700, then okay, please at least hold 17,600, which also ties in with this triangle support at that point as well. So you got a double pattern confirmation there, which gives you confluence. When two things are showing you the same thing, that gives you confluence. Okay, so at the very least, I'd want to hold that, and that's significant. We've said that for a while. This is your Terra Luna collapse, 17,600. That was the low. All this below that, which took us down to 15,500, associate that with the FTX and all the stuff that unfolded thereafter. So it's important that we don't just come all the way back down below 17,600. That would not be good at all, okay? And I will give that warning if that happens. Okay, now let's take a look at a few EMA ribbons to give us some other indicators because they've been really telling, okay? And if you look here on the daily chart very simply, what are we seeing? We're running into our 200 exponential moving average. So another reason for us to suspect that there could be a retracement here. And again, on a daily chart, you can afford to have quite a big retracement. You can even come down to these levels at 18,300 range without, going into your EMA ribbon. So there's plenty of room here to retrace, but still hold our daily EMA trend as bullish. That's good news. Let's now notch that down to the 4-hourly. And you can see that the 4-hourly is starting to get a decent correction here, printing quite a painful candle at the time of recording, right? Down 1.5% in that 4-hourly candle. So here, you start to touch your EMA ribbon at 20,000. Okay, so I would not be surprised to see us really come into the EMA ribbon and really test it. Remember that 20,000 I said? That would be about here. Remember that 18,700 level would mean we would have flipped our EMA ribbon bearish on the 4-hourly. Let's notch it down a little bit further. Let's go to our hourly. And this is where you're seeing what's going on. We're consolidating in that bull flag into the hourly EMA ribbon. So now the question is going to be, do the bears literally have nothing in them and we can even continue running on the hourly, which I think is very unlikely? Or are we going to get forced to the downside? Now I'm going to show you the CME gap as well and explain exactly what that means. So make sure you stay tuned because it's important that people understand the CME gap because that's also a bearish indicator as well. Let me now notch back up to the daily. And what I'm going to do is I'm going to remove the EMA ribbon and I'm going to show you the Bollinger Band. Okay, and as you can see, the Bollinger Band is trying to gain some normal resemblance. But what's more important, because of the huge rise, this Bollinger Band has kind of been messed up, right? It's not reliable right now. So let's head up to the weekly. And when you go up to the weekly, you start to see that it's no coincidence that we will see some resistance at this level because we're coming right up to the top of the Bollinger Band. The run we saw up this week that has just gone is a huge run from roughly close to the bottom of the Bollinger Band all the way to the top. but it's not easy to just rip this off and completely run to the upside. There will be some challenges there. I can't make this video without talking about the macroeconomy as well. It's really important, particularly when we're excited with our short-term trades, that we understand the macros and the fact that there's still some more pain ahead. I've been doing a lot of research into Morgan Stanley, JP Morgan, BlackRock's outlook, and you can see that they're expecting continued volatility at least through Q1 and Q2 of this year. So I don't want people to get overexcited. I'm particularly not getting overexcited. I'm expecting more pain. We have to remember, everything we are seeing right now is a relief rally. We're still in a weekly downtrend as characterized by the EMA ribbon. We're still below our weekly EMA ribbon. So yes, we can rejoice. Yes, we can enjoy these movements in price and trade them if you're trading on a short-term time frame. But to just think we're suddenly out of it and entering our next bull cycle, that's a little bit far-fetched. We've got some work to do. Labor figures need to start to fall in line. Yes, we've seen CPI. You've got PPI inflation coming out later on this week. You've got some Fed officials speaking. Remember, stock market is closed today in the US market, so Bitcoin's got a free run today, but then it'll be back open for tomorrow. So there's a lot to play for. We're still expecting a lot of uncertainty. It's not that we're just out of it. This year is not going to be straightforward in my opinion, but with the right macroeconomic data, like we had positive CPI, if we can get good CPI over the next couple of months, if we can get good labor figures over the next couple of months, if we can see tech valuations start to bottom out, then things can improve. But just remember, many companies are laying people off. Many people are still expecting a recession. The argument is as to whether is it going to be a mild or a moderate one. I think the belief that it's going to be a deep, painful one has started to subside now that the data is improving. But many are still expecting a challenging year for growth stocks, right? And growth stocks is what's correlated to Bitcoin. So just wanted to share that as a caveat. I don't want everybody to get gung-ho. We need to stay calm, stay rational, and stay data-led. Speaking of which, the market has priced in no exceptions here. We have no room for error at the data points or the next FOMC meeting. For the next FOMC meeting, which is just 2 weeks away, the market, 60% is expecting 25 base points. And almost 40% of the market is expecting a pause. Guys, you got to understand what this means. This means the market is pricing in any remnants of good information, right? Any good data is already priced in. So the moves we've seen in the market, some people are saying, oh, this is just shorts getting wrecked. Shorts are getting wrecked as a consequence of the major shift we had in inflation and some of the data. That's significant. There was a macroeconomic shift. We did see green shoots, and that's why markets are feeling a little bit buoyant. It's not just the fact that Bitcoin bulls have just crashed the market and therefore caused bears to get liquidated. No, that's not what's happened. What we've seen happen is a shift, but what it means now is we're on this tightrope where we cannot make any mistakes, right? They've priced in that the Fed are at minimum going to do 25 base points. So if the Fed come out and do 50 base points, it's going to get ugly. It's going to get ugly fast. Even if the Fed come out and do 25 basis points, right, which is no guarantee, 40% of the market is going to be upset because they've already priced in a pause. So that's some redness to come in the market. So normally when you get 25 basis points after 50 basis points and 75 the meeting before, you would have thought that the market would be buoyant. But no, investors are always trying to front run the market and front run the data. So they're already pricing this all in. So anything positive that comes out isn't going to give us those huge rallies because we're already getting them. Instead, it's more downside risk that is being delayed down the line. So we've got to be very, very careful going into this FOMC meeting. One more bearish indicator that a lot of people are talking about is the CME gap. Now, the CME gap is a phenomena whereby the price tends to fill gaps. You need to remember, Bitcoin CME futures trade on traditional market hours, but obviously Bitcoin doesn't, right? And if you want a separate video explaining all of this, let me know. Maybe I can do a dedicated video on how to trade the CME gap, because just like you would use the EMA ribbon or any other technical indicator, you can trade this CME gap, and a lot of people do so successfully. So the premise behind this, and it doesn't always fail, but a lot of times the CME gap fails, is what it does is it closes Friday at a certain level. So on this instance, on Friday, the Bitcoin CME closed at 19,550, so 19.5K roughly. Now, what you'll notice is it opened up here, okay, at a level of 20,985. So the thesis goes that this will have to fill the gap and go to the close, and to go, in other words, it has to go back to 1950. And so that's another bearish indicator which a lot of people are shouting from the rooftops about. Let's check in on the Dixie, and you've got a flat day here on the dollar index. Really happy with this trend. It continues to be a downtrend, nicely extended from the EMA ribbon. Again, if Bitcoin's going to fall, don't be surprised to see dollar index just go and touch the EMA ribbon, and hopefully we do the same as what we just did there, which is send it right back down to the downside. Remember, this is inversely correlated to Bitcoin. The dollar index falling means risk is rotating back on, which is good for growth stocks and good for tech. But the question is going to be, how long does that last for? How long is this relief rally going to last for? Will we manage to run deep into our weekly EMA ribbon and try to potentially flip it around the 24,000-25,000 region? Or was this just a relief rally and the bears are now going to step up and give us a violent turn to the downside? These are the things we have to be very careful about when trading on a short time frame. Thanks for watching, guys. Don't forget to smash up like, don't forget to subscribe, check out this video here, and I'll see you in the next one.